Welcome to the Sharkpreneur podcast with Kevin Harrington and Seth Greene. Kevin Harrington is the inventor of the infomercial, one of the original sharks from the hit TV show Shark Tank, and has generated over $5 billion in TV and digital direct response sales. Seth Greene is the world's first trusted authority on cutting-edge direct response marketing, a best-selling author, and the only 3-time Marketer of the Year nominee. On the podcast, Kevin and Seth interview Sharkpreneurs who share straight talk on what it takes to explode your business.
Why do so many businesses struggle while others seem to explode overnight? Do you wish you had the secret to this type of exponential growth? Now, I've scaled more than 20 businesses to over $100 million, and it's not just luck. In my new book with Mark Tim, Mentor to Millions, you'll learn the repeatable framework I use in all my business ventures for massive success. Order at kevinmentor.com and get over $1,000 in bonuses. Head to kevinmentor.com.
Welcome to the Sharkpreneur podcast. This is your co-host, Seth Greene. Today I have the good fortune to be joined by Matthew Sullivan, CEO and founder of QuantmRE, a company that solves a real problem for homeowners by helping them access a portion of their home equity without taking on more debt. That means no interest, no monthly payments. Matthew's got a proven track record in real estate innovation, which we're going to hear about in just a minute. Matthew, thanks so much for joining us.
Seth, thank you for having me.
All right, so let's go back in time. How did you get started? You've got an interesting
how far do you want to go back? Which means how many listeners do you want to lose? So not too far. Well, if we go back, I'm originally from the UK, and I moved over to the US about 7 years ago. And one of the first things I did was get involved with real estate crowdfunding platforms, because there was a change in legislation with the Jobs Act, which really opened up the whole ability for online platforms to raise capital. So really, that's where my initiation into sort of US real estate and online trading really began. And from there, we stumbled across a really interesting asset class very early on in that period, which I sort of became slightly obsessed by. And that asset class was the sort of early days of what have now become home equity agreements, which is the ability for investors to buy into the equity appreciation of the home and unlock some equity and some cash for homeowners. So really, I sort of started out looking at this about 5 years ago. We set the company up just under 3 years ago. So we've been involved in the space, and we've been growing QuantmRE for just coming up for 3 years.
Okay, so what is a home equity contract? How does that work?
Well, if you look at the problem that we solve, as you said at the beginning, there are millions of homeowners. I think there's almost 15 million homeowners who have 50% or more equity in their homes. And altogether, if you look at the amount of equity in US residential real estate, it's approaching $19 trillion. So there's an enormous amount of equity, and currently, the only way that you can unlock equity is to borrow money. So even though you may have built up hundreds of thousands of dollars of equity in your home, the only way to access that is to go deeper into debt. And for many people, that's difficult, if not impossible, if they don't meet the requirements of the bank, or that it may be something that they simply just don't want to do. If you've spent your life paying off your mortgage, then it's sort of anathema to you to go back into debt. So that equity sits there locked up. So what we do through a home equity agreement is enable investors to buy into the potential appreciation of the home in exchange for a lump sum. So that gives the homeowner what they need, which is cash. Because it's not debt, there's no interest, there are no monthly payments, and it's not added to your credit report as more debt. We can also be much more flexible when it comes to looking at things like debt to income ratios, your income, whether you're W-2 or 1099. And most importantly, it enables you to access some of the equity that's trapped in your home without having to go back into debt.
Okay, so let's say you're the investor and I'm the homeowner, and I have $100,000 equity in my house. Are you factoring the money, or am I getting 80,000? Am I getting 100,000? I'm sure it varies, but give me some type of, I'm getting a check for X amount.
Yes. So let's look at the trade. So in other words, what is the exchange of value? On one side, you have a homeowner who is equity rich and cash poor. On the other side, you have an investor who's looking to deploy some of their capital into a real estate backed investment. So to give you some examples, the agreement, which is really very much like an option agreement. So a few critical points here. First of all, we don't go on title as a co-owner. So you don't need to sell a portion of your property to us. We don't have any rights and privileges as an owner. So we're not going to come and camp out in your spare bedroom. But the important thing is that there are limits to the amount that we will invest, and there are limits to the amount of equity that there needs to be in order for us to run a transaction with you. Now, the investors come from primarily institutions, so they're hedge funds, they're family offices, they're endowment funds, long-term capital, where the allocation is ideally suited to putting into equity-based investments that have a long horizon. So the agreements themselves run for up to 30 years. So that means as a homeowner, you've got up to 30 years to settle the agreement. So it will become due. There is an obligation to make a payment to repay the investor, but that obligation is not debt. It is a different type of obligation.
Okay, so if you give me $100,000 for my equity in my home, now, how do you make money? How do I pay you back without, I mean, do I have to sell my house to pay you off? How does that work?
So the agreement is an option agreement. So that means that in exchange for capital, you give us the right to participate in some of the appreciation of the home. So to answer your question, how does the investor get paid? They get paid by sharing in some of the increase in value of the home from the date that you sign the agreement to the date that you settle the agreement.
Right, but how are you realizing? Let's say my house, you're right, and my house goes up in value. The only way historically I'm getting that is if I sell it.
But as I was saying, so your options are not restricted to selling the house. So you can refinance this agreement. You can buy back the agreement through some other way. You might find yourself in a position a few years down, if you've repaired your credit or if you've received a lump sum from some other source, you can buy back the agreement at any time with no penalty. So there's no early termination clause. There's no penalty for buying the agreement back. So the way the agreement works is that we calculate a share of the increase in value, and we use third-party appraisers at the beginning of the agreement to agree what the value of the home is. And then if you sell your home and it's a genuine arm's length third-party sale, then we'll use the sales value for the value of the home. Otherwise, if you want to buy back the agreement, then we'll instruct a third-party appraiser. And at that point, what we as the investors would be looking for is to get back our original investment, which can be up to 20% of the value of your home. So it doesn't really matter. It's not a percentage of your equity. Everything's calculated based on the value of your home. And then when you settle the agreement, we'd like to get back the original investment together with a share of the increase in value. And that share depends on how much money we invested in the first place. So the amount that we get back is correlated to the value of the home, and also it depends on how much you took out in the first place.
Okay, so what happens? So obviously you've got to then believe that my home is in an area that over the next 30 years is going to appreciate. Yes. So you have to be picky. You can't do every person that comes to you. What happens if you're wrong? What happens if it doesn't go up in value?
Well, there's two things that we do, because obviously to make this attractive to both parties, it has to be attractive to investors. And that is a common question. What happens if house prices don't go up? What happens if they stay the same or if they go down? So to protect the investors against your house going down in value, what we do is we discount the value of your home slightly at the beginning of the contract. So your house might appraise at, say, $500,000. And what we say is we're going to apply a discount to that. So we will start the clock running at a figure that's below $500,000. So that means if you sell your home 5 years later for the same price and it hasn't gone up at all, we've built in a little bit of upside for the investor. So they will take a share of that inbuilt upside to make sure that they get a return on their investment. And that gives them the motivation to be able to invest in these. From a homeowner's perspective, you know from the outset what these numbers are. So there's always clarity, there's always transparency, there's never any doubt as to what the multiple will be. And the most important thing is we can never eat into your existing equity. So in other words, it's very different to a reverse mortgage where if your house value goes down, you give away more and more equity. With us, we're restricted to the amount that we invested together with a share of the increase in value. And if your house significantly falls in value, we run the risk of actually losing money on the transaction, which is, again, very different to a traditional loan.
Absolutely. Now you've done over 100 of these. Are there any type of averages, numbers in terms of length of time till repayment, average rate of return across the board that the investors are getting? I mean, we're not making any offers on this show. Insert your standard legal disclaimers and do your own due diligence. But what type of averages or numbers are you seeing?
Well, I think really what that figure is the aggregate number of transactions that we as a team have done through various different, through various different lives, as it were. So those aren't the number of deals that Quantum as a whole. We've done fewer than those. It's a little early to tell. So over the last 3 years, 3 to 4 years, that's when we've been concentrating on these. What we're seeing, though, is that these agreements do significantly outperform the underlying house price index, because the way that they operate is that they give the investors a return, which is a magnified return based on the house price index. And what that means is if, for example, you were to unlock 10% of the value of your home, then when you sell your home or you buy back the agreement, you don't get back as an investor 10% of the increase. You would get 25 to 35% of the increase. So you get a magnified share of the increase in value. So because of that, we can look at the underlying house price index, and for homes within that area, we can quite easily calculate what the likely increase in value has been, and therefore there's a direct correlation to the return for the investors. So we have seen, based on those numbers, early sort of double-digit returns, which is consistent with the returns of the underlying house price index.
That's absolutely incredible. It's obviously a creative and unique solution. What are the restrictions on the investment side? You need to be an accredited investor. Do you need to meet minimum net worth and income requirements? And how does that work?
From the investor side, at the moment, we're concentrating on institutions and accredited investors. Okay. So that's the standard test. Over time, though, however, our objective is to make this type of investment much more accessible to non-accredited investors. Great news is that I'm not sure you've seen, but the SEC have increased the amount that can be invested under regulation crowdfunding from $1 million to $5 million, and also there are other exemptions that we plan to use so that we can create an exchange or an opportunity for non-accredited investors ultimately to fund these transactions on a peer-to-peer basis. So to answer your question, right now, institutions, small offices, family offices, and accredited investors. But we hope that will change and widen and open up to a much wider investment community by this time next year.
That is fascinating. Now, if I were buying the property entirely as an investment property, I'd get tax deductions, depreciation, other benefits of owning real estate. Do I get any of those as an investor here, or any passive flow through? How does that work?
Well, there's no cash flow And as you're investing, because it's an equity investment, but the deals have been structured to give you the same capital gains tax advantages as you would if you were investing directly in the property. So you have the same benefits. Incidentally, from a homeowner's perspective, it's tax deferred. And again, we're not accountants, do your own research. But what that means is the capital you get as a homeowner does not have a tax burden that's immediately attached to it.
So it doesn't show up as income.
Exactly, because it's settled when the agreement is finally bought back, which can be up to 30 years' time. So if you would then have a capital gains tax liability, you would then factor in the amount that you'd already received as part of that. But if you are a homeowner and you're looking to diversify some of your equity into other investments without that burden of monthly payments and without the risk that if the investment goes wrong and you still got to make those monthly payments, then it's very useful to have hundreds dollars to be able to make that investment.
That is absolutely fascinating. I mean, what's the biggest challenge you're facing now in terms of like getting the word out?
It's precisely that. It's education. I think the natural reaction is, it's too good to be true. I don't understand. It's a debt. It's debt, but you're pretending that it's not. But part of the challenge is really explaining to people that in any commercial real estate transaction, you have multiple layers of funding, everything from senior debt, junior debt, mezzanine, preferred equity. In a residential home, it's just debt. Different flavors of debt, but it's debt. And really what we're doing is we're using the same mechanisms that have been used in commercial properties for decades, if not far longer than that, using and applying that to residential homes to the benefit of the investor. Because remember, this is a way for investors to get access to an untapped trillion or multi-trillion dollar marketplace, where you are buying into homes that are not for sale. So you're working as partners with the homeowner. You don't have that cost of carry. You don't have the maintenance. You don't have toilets, termites, tenants, trash, all of those issues.
4 T's.
Yeah, I mean, it was 3, but I've upgraded it to 4 now.
See that? That was very nice. Your passion's obvious. What do you like best about what you're doing?
I think really it's just the scale of it and the fact that it is solving a real problem. And I don't mean that to be trite, but this is something that I have struggled with over the years as a homeowner, and as an entrepreneur, which I've, stroke in brackets as an unemployable person. It's always been difficult to go to the bank because you have to go back and dig out, 15 years worth of tax returns and, that sort of thing. And the obligatory pound of flesh. But this is a way that really does help people unlock something that is already theirs. And it's a great trade. So it's a great trade for the investor. It's a great trade for the homeowner. It's a very simple business that is very, very scalable. So it's very exciting because of the scale, because of what it could become, and the fact that this is not something that's going to go away.
Absolutely. You mentioned the peer-to-peer side. You mentioned the ultimately making it available on a broader basis. I mean, you could be a gigantic matchmaker. And
again, that's the beauty of something like this is it is the fact it could be an inch deep and a mile wide. Exactly.
Yes.
So, and it feels like the culmination of everything that I've done in the past has been like a learning exercise for all of the components that we need to make this together. So that together with a team that we have that really is truly expert in this field, it's a very exciting time.
Absolutely fascinating program that you've got. For our folks who are listening and watching and want to learn more, where is the best place for them to learn more about you and Quantum?
It's the website QuantmRE, which is QuantmRE, www.quantmre.com. I don't know why we still say the www thing. The throwback to times, pre-digital. Everything's there. Contact. We've got a free guide that you can download. There's a calculator there that enables you to find out as a homeowner what the value of your property is and how much you could unlock. From an investor's perspective, we will be switching on the ability for accredited investors to participate probably by the early second half of next year, if not beforehand. But if any of your investors looking to participate, we do have vehicles and structures that we can introduce you to immediately. So even though it's not directly available on the website, please drop me a note or get in touch somehow, and we will point you in the right direction.
All right, fascinating program. This is Seth Greene from Sharkpreneur with Matthew Sullivan from QuantmRE.com. Matthew, thank you so much for joining us.
Seth, it was my pleasure. Thanks for having me on.
Thanks everybody for watching or listening. We'll talk to you next time.
Do you need money to fund your idea, product, or service? Are you ready to take your business to the next level but need capital to get it done? Kevin Harrington has heard more than 50,000 pitches and knows how to help you make the perfect pitch to get the funding for your entrepreneurial dream. He's distilled the process down in his perfect pitch cheat sheet, and it's yours for free. Just text PITCH to him right now at 727-888-2100. Text PITCH to 727-888-2100 right now and claim your free perfect pitch cheat sheet. Text PITCH to 727-888-2100 to start funding your dream today.
This show has been produced by Market Domination, LLC. To discover how you can have your own show completely done for you and turn it into a real published book and become the authority in your marketplace, go to www.marketdominationllc.com/podcast offer.